For years, Americans have been hearing warnings about a recession. Every time inflation rises, interest rates increase, or the stock market experiences turbulence, experts begin discussing the possibility of an economic downturn. Yet despite countless predictions, the U.S. economy has continued moving forward. Employment remained stronger than expected, consumers kept spending, and businesses adapted to changing conditions. Because recession warnings have become so common, many people have started ignoring them altogether. But history shows that the most dangerous recessions are often the ones that arrive when the majority of people least expect them. The next recession, if it comes, may not look like previous downturns. It may emerge from a combination of factors that most Americans are not paying attention to today. One reason the next recession could catch people off guard is because economic conditions often appear strongest just before significant slowdowns begin. During good times, confidence rises. Consumers spend more money, businesses hire more workers, and investors become optimistic about the future. This optimism creates a sense of security that can make risks seem smaller than they really are. In hindsight, many economic downturns appear obvious, but before they occurred, most people believed the economy would continue growing. Human nature tends to focus on recent success rather than future risks, which is why warning signs are often overlooked. A major factor that could contribute to the next recession is the growing burden of debt throughout the economy. Over the past decade, governments, corporations, and consumers have all accumulated significant amounts of debt. Low interest rates made borrowing relatively affordable, encouraging spending and investment. However, the environment has changed dramatically. Higher interest rates mean that borrowing costs have increased. Loans that once seemed manageable are becoming more expensive. As debt payments consume a larger share of income, spending power declines. This process often happens gradually, making it difficult to notice until its effects become widespread. Consumer spending remains one of the most important drivers of the American economy. When people feel confident about their jobs and finances, they spend money on homes, cars, travel, entertainment, and countless other products and services. But rising costs can eventually strain household budgets. Credit card balances have increased in recent years, while interest rates on those balances have climbed. Families facing higher costs for housing, food, insurance, and healthcare may begin reducing discretionary spending. At first, these adjustments seem small. Over time, however, reduced consumer spending can ripple through the entire economy. Housing has historically played a critical role in economic cycles, and it could once again become an important factor in a future recession. Higher mortgage rates have significantly increased the cost of purchasing a home. Many potential buyers have been priced out of the market, while existing homeowners are reluctant to sell because they do not want to give up lower mortgage rates obtained in previous years. This creates reduced activity across the housing sector. Construction companies, real estate agents, lenders, and countless related industries depend on a healthy housing market. When housing slows, the economic effects often extend much further than people realize. Businesses are also facing new challenges. During periods of low interest rates, many companies borrowed heavily to fund expansion, acquisitions, and stock buybacks. As debt matures, those companies must refinance at higher rates. This increases financial pressure, particularly for firms operating with thin profit margins. Some businesses may respond by reducing hiring, delaying investments, or cutting expenses. These decisions may improve short-term financial stability, but they can also contribute to slower economic growth. When enough companies make similar choices simultaneously, broader economic weakness can develop. Another reason the next recession could surprise people is the strength of the labor market. Employment remains one of the most closely watched indicators of economic health. As long as unemployment remains low, many people assume the economy is fundamentally strong. Businesses typically avoid layoffs until financial pressures become significant. By the time unemployment begins rising noticeably, economic weakness may already be spreading. Inflation continues to play a central role in the economic outlook. Persistent price increases reduce purchasing power and force consumers to make central banks than many investors expect in order to prevent inflation from accelerating again. This combination of elevated creates a difficult environment for households. Financial markets are another area where warning signs can emerge before economic conditions deteriorate. Investors constantly evaluate future risks and opportunities. Bond markets, in particular, often attract attention because they reflect expectations about growth, inflation, and government borrowing. Rising treasury yields, inverted yield curves, and changing credit conditions have historically provided clues about future economic developments. While no single indicator can predict a recession with certainty, financial markets frequently identify emerging risks long before they become obvious to the general public. Government debt represents another challenge that receives increasing attention from economists. The United States continues to run large budget deficits, requiring substantial borrowing to finance government operations. As interest rates rise, the cost of servicing this debt increases. A growing share of government resources must be directed toward interest payments rather than other priorities. Although governments can operate differently from households or businesses, rising debt levels can still influence economic conditions through higher borrowing needs, changing investor expectations, and increased fiscal pressures. Global economic conditions add another layer of complexity. The modern economy is deeply interconnected. Events occurring in one region can quickly affect markets around the world. Trade relationships, supply chains, commodity prices, and financial flows connect economies in ways that did not exist decades ago. A slowdown in major international economies can reduce demand for American exports. Geopolitical tensions can disrupt trade and investment. Financial instability in one country can create uncertainty elsewhere. These interconnected risks make economic forecasting more difficult and increase the potential for unexpected developments. Technology may also contribute to economic disruption in ways that are difficult to predict. Artificial intelligence, automation, and rapid technological innovation are transforming industries at an unprecedented pace. While these advancements create opportunities for productivity and growth, they can also create uncertainty for workers and businesses. Entire industries may evolve more quickly than expected. Companies unable to adapt could struggle, while workers may face changing skill requirements. Economic transitions driven by technology can create periods of instability even when long-term outcomes are positive. An important lesson from previous recessions is that crises rarely emerge from the sources most people expect. Before the financial crisis of 2008, many investors believed housing prices would continue rising indefinitely. Before the dot-com crash, technology stocks seemed unstoppable. Before other economic downturns, confidence remained high despite growing risks beneath the surface. The next recession may originate from a completely different source than current headlines suggest. This uncertainty is one reason economic forecasting remains so challenging. Psychology plays a powerful role in economic cycles. When people feel optimistic, they take more risks, they borrow more, invest more aggressively, and spend more freely. Confidence itself becomes a driver of growth. However, confidence can change rapidly. A single event, unexpected policy decision, financial shock, or market decline can alter perceptions almost overnight. Once confidence begins deteriorating, spending and investment often slow. This shift can create a self-reinforcing cycle that accelerates economic weakness. Corporate earnings may provide another important clue. Businesses ultimately depend on customers willing and able to spend money. If consumer demand weakens, corporate profits can come under pressure. Investors often focus on revenue, growth, and earnings expectations because they provide insight into broader economic conditions. A widespread slowdown in corporate profitability can influence hiring decisions, investment plans, and stock market performance. These effects can spread throughout the economy in ways that are not immediately obvious. The banking sector also deserves attention. Banks play a crucial role in providing credit to consumers and businesses. When economic risks increase, banks often tighten lending standards. Loans become harder to obtain, and borrowing costs may rise further. Reduced access to credit can slow economic activity, particularly for small businesses that depend on financing to operate and expand. Credit conditions may not receive as much public attention as stock prices, but they can have a significant impact on economic momentum. One of the most overlooked risks involves complacency itself. Because the economy has remained resilient despite numerous warnings, many people assume it will continue overcoming future challenges. This belief may encourage individuals, businesses, and investors to underestimate potential risks. History suggests that excessive confidence often develops near turning points in economic cycles. The longer a period of stability lasts, the easier it becomes to believe that stability will continue indefinitely. At the same time, it is important to recognize that recessions are a normal part of economic cycles. Economic growth does not move in a straight line forever. Periods of expansion are typically followed by periods of slower growth or contraction. Recessions can be painful, but they also help correct imbalances that build up during periods of rapid expansion. The goal is not to fear every downturn, but to understand the factors that may contribute to one and prepare accordingly. Preparation is often more valuable than prediction. No economist, investor, or policymaker can predict the exact timing of a recession with complete accuracy. Markets are influenced by countless variables, many of which are impossible to foresee. However, individuals can strengthen their financial resilience, regardless of economic conditions. Reducing unnecessary debt, building emergency savings, diversifying investments, and maintaining a long-term perspective can help households navigate uncertainty more effectively. The next recession, if it occurs, may not arrive with dramatic headlines announcing its approach. It may begin quietly through slowing consumer spending, weaker business investment, tighter credit conditions, or shifting investor sentiment. Economic slowdowns often develop gradually before becoming widely recognized. By the time most people realize conditions have changed, the process may already be well underway. What makes the current environment particularly interesting is the combination of factors involved: rising debt, higher interest rates, persistent inflation concerns, global uncertainty, technological disruption, and changing financial conditions are all interacting simultaneously. Each factor alone may not trigger a recession. Together, however, they create an environment where unexpected outcomes become more likely. The biggest mistake investors and consumers can make is assuming that the future will look exactly like the recent past. Economic conditions evolve, risks change, new challenges emerge. The next recession could surprise everyone, not because warning signs are absent, but because they are appearing in places many people are not watching. History repeatedly demonstrates that economic turning points often arrive when confidence is highest and concern is lowest. Whether the next recession occurs next year or several years from now, the underlying lesson remains the same: paying attention to long-term trends, maintaining financial discipline, and preparing for uncertainty are often more important than trying to predict the exact moment when economic conditions will change.